You have $500 extra this month. It's not a lottery win, but it could be the moment that changes everything. Should you throw it into investments, betting on the future? Or should you finally tackle that debt that's been quietly stealing from you month after month? Choosing wrong could cost you thousands or even years of financial freedom. This isn't just about crunching numbers. It's about building a life where you call the shots. In 2025, when money moves faster than ever, making the right call matters more than ever. So what's the smartest move for your future? Let's break it wide open. The reality of debt in 2025. Debt in 2025 isn't some far-off problem for someone else. It's sitting in homes on credit card statements wrapped around student loan bills. Right now, U.S. household debt has blown past $18 trillion. The average unpaid credit card balance alone is over $7,300, with new card offers flashing brutal interest rates close to 22.6%. Student loans are no better, weighing in with federal rates around 6.55% for undergraduates. Mortgage rates hovering at about 6.6% are making even homeownership feel like a heavy burden. But the real danger isn't just owing the money, it's the psychological chains that come with it, the constant background noise of stress, the lost opportunities, the invisible limits debt draws around your life. If you want to build wealth, you can't ignore the anchors dragging you down. When paying off debt is the best move. The brutal truth is, if you're carrying high-interest debt, you're already losing before you even step onto the playing field. Every month that passes is like standing still while the financial ground beneath you crumbles. Debt with interest rates above 8%, especially brutal ones like credit cards and personal loans, needs to be treated like a five-alarm fire, not a slow-burning problem to eventually handle. Take a simple example. A $7,000 credit card balance at 22% APR doesn't just sit there quietly, it grows. It compounds against you. Left unchecked, it can easily double before you even realize it, swallowing your future plans whole. Every dollar you throw at that debt is a guaranteed return you simply can't replicate anywhere else. Not even the hottest investment opportunities can promise you a 22% return, risk-free. And beyond the brutal math, there's something just as important, the emotional payoff. Knocking out a big chunk of high-interest debt is like taking a heavy backpack off after carrying it up a mountain. Your stress drops, your mental clarity improves. Suddenly, decisions get easier. Opportunities feel within reach. You can say yes to bigger dreams instead of being chained to yesterday's mistakes. Sometimes the best investment isn't about chasing gains. It's about clearing the runway so your future has a real chance to take off without baggage weighing you down. When investing makes more sense. Not every debt hanging over your head is a ticking time bomb ready to explode. Some debts, if managed wisely, are actually strategic tools that can work in your favor. Mortgages with fixed rates around 6% or federal student loans aren't the villains in this story, and they shouldn't scare you into pausing your wealth-building plans. When you consider that the S&P 500 has historically delivered an average annual return of about 10%, even after adjusting for today's cooler inflation, around 2.4%, the math speaks loudly. Investing wins in the long game. Instead of racing to wipe out a low-interest mortgage early, putting your money to work in index funds, dividend stocks, or other solid long-term investments could end up doubling, even tripling your net worth over the next 10 to 20 years. Let's zoom in. Investing just $500 a month for 10 years, at an average 10% return, grows into roughly $95,000. Keep that pace for 20 years, and it balloons to over $300,000. That's the unmatched power of compounding, and the reason starting early, even if it feels small at first, matters so much. If your debts aren't drowning you, and you're disciplined about making minimum payments, investing now could build the kind of future wealth that paying debt alone could never match. It's not just about getting by. It's about building a life where you aren't surviving, you're thriving. The hybrid approach. What if you didn't have to choose between crushing your debt and building your future? Some of the smartest financial strategies today don't force you into a painful either-or corner. Instead, they offer a hybrid approach, a way to eat your cake, build a bigger one, and maybe even open a bakery. It's simple but powerful. Take about 70% of your available extra money and throw it directly at any high-interest debt you have, attacking it like your financial life depends on it, because it does. At the same time, allocate the remaining 30% toward investments toward the future version of you who will someday need that nest egg to be strong, growing, and ready. This method lets you fight the fires that are burning hottest while also planting seeds that will grow into massive financial trees down the line. You're not just reacting to debt anymore. You're actively creating a future that's bigger than your bills, your fears, or even your current paycheck. And the best part? The earlier you start, the more explosive the rewards become, thanks to the quiet but unstoppable force of compound interest working behind the scenes year after year, building wealth you might not even believe is possible yet, but will be if you give it time to grow. Decision-making framework. If you're still stuck, it's because personal finance isn't one-size-fits-all, it's personal. The smart move starts with answering a few critical questions about where you stand. First, look at your debt. If the interest rate is higher than 8%, prioritize paying it off. If it's lower, take a closer look at the big picture. Next, do you have an emergency fund, real cash, not credit cards covering at least 3 months of expenses? Without that, even the best investment portfolio won't save you in a crisis. Build that cushion first. Finally, know yourself. If the thought of market dips and volatility makes your stomach churn, you might want to lean harder into debt freedom first before throwing money into investments. On the other hand, if you can handle a little turbulence in exchange for long-term gains, starting to invest sooner could be the best decision you ever make. Tools and resources. You're not fighting this battle alone. There are tools right now that can make managing your money 100 times easier. Budgeting apps like Mint and You Need a Budget, YNAB, help you track exactly where your money's going, plugging leaks before they sink your ship. Online calculators let you see how fast you could wipe out your debt or how much a small investment could grow if you start today. Investment platforms like Vanguard, Fidelity, and Robinhood lower the barriers so even beginners can build serious portfolios without needing a finance degree. The tech is there. The real question is whether you're willing to step up and use it to take control. The real answer isn't as simple as always pay off debt or always invest. It's smarter than that. If your debt is bleeding you dry with 20% plus interest, clearing it first is the smartest investment you can make. But if your debt is manageable, low interest, and under control, investing early could transform your future in ways that debt repayment alone never could. The best part, you don't have to choose sides. You can do both: balance them, control them, master them. Freedom isn't just about owing nothing. It's about building something real and lasting. If you found value in this breakdown, smash that like button, drop a comment sharing your strategy or your next move. Share this with someone who needs clarity, and make sure to subscribe to the channel. Don't forget to hit the bell icon so you never miss another no-nonsense guide to building the future you deserve.